How's it going, everyone? We have Jerome Powell speaking in about 5 minutes, giving his views on the economy, giving his thoughts on interest rates, on jobs numbers, and all that. So we're going to be watching that. I'm going to be playing it live for us here. Also, we'll give some thoughts at the end, and we'll also be going through a little bit of crypto news. If you don't mind, hit subscribe. If you're rewatching this, maybe you want to skip a few minutes in to hear Jerome Powell, but we do have a couple interesting things happening, or a couple interesting stats we should look at before Jerome Powell's speech. While you're coming in here, you can always hit the subscribe button, and you can also check out the link underneath the video to Margex in case you want to start trading crypto. There is that link. Seems like we are just pushing against this line here, so it will be interesting to see what happens next. But yeah, how's everyone doing? Hope you're all doing well. Let me switch over to comments here so I can see everything. I'll go through some questions at the end too. But yeah, I mean, it should be interesting. I guess if you think Jerome Powell is interesting to listen to, but it should be interesting to see how the market reacts. Right now, there's a 28% chance that we get a 50 basis point cut this next meeting, and then a 72% chance that we get a 25 basis point cut, basically zero chance that we get zero cut right now. And this is interesting from James Van Straten. In previous years with Jackson Hole, Bitcoin has seen some volatility, but since the ETFs launched this year, trading has been muted on weekends. Don't expect much till September. So in 2019, change before was a negative 5.9%. And then the day of, basically nothing. The day after, it went back up 2.7%. You can continue to look here. Like 2021, there's some volatility, up 2.5% the day before, down 4.1% the day of, then up 4.4% the day after. I'm trying to think of how big a move that would be. A couple $1,000 maybe if Bitcoin was around 50,000 at the time. We're talking about 50 to 52,000, 52,000 to 50,000, etc. 2022, there's a big move the day after, and then it doesn't show 2023 on here. But yeah, kind of interesting. There is some volatility for sure around Jackson Hole. But this is kind of the meeting that bridges, or the speech that bridges the gap between last month and the next rate cut. A lot of people will be looking for his thoughts on jobs numbers being revised down last week, and some of the CPI data. CPI has been coming in low. I think CPI last report was 2.9%. And of course, we do have PCE inflation coming next week. So we'll have to be on the lookout for that. For everyone just filing in, we have Jerome Powell going live in about 2 minutes, or he should be going live in about 2 minutes. We'll play that for you guys. If you don't mind, again, just hit the like button, hit the subscribe button. There's also the link to Margex underneath the video. I say to hit the like and subscribe because this will push it out to more people. And then, it would be nice if we could get a good group of people asking questions after this, or, given their thoughts on the FOMC as well. Okay, I've never actually live streamed either with audio. You have to do something a little bit different if you're watching a video. So once that comes up, let me know if everything sounds good. But yeah, we do have some interesting news too, which we'll be going through after the video most likely. Russia is going to launch 2 new crypto exchanges. We also have news that Sony's going to launch an ETH layer 2. Justin Sun reassuring users after the Tron DAO reserve withdrew 12,000 Bitcoin, backing the USDT stablecoin on Wednesday. This is interesting. This reminds me of USD, but they're pulling backing away. So I don't know. There's some interesting stuff that we'll have to go over after this, but we should focus on Jerome Powell while this is going on. Let me actually change something real quick too, just so that I can make sure that you can hear the audio. Window. Okay, we should be good now. Let me know if you can hear the volume. You should be able to. Yeah, let me know if you can hear. So far, I mean, there's no one speaking. It's just like people talking, chatting. But I did do a test before this, and it looked like it should work. Okay, sweet. Thank you guys for the confirmation.
All right. Good morning. Thank you, and welcome to the first day of sessions for the Federal Reserve Bank of Kansas City Jackson Hole Economic Symposium. My name is Karen Dinan, and I'm going to be your moderator for today's sessions. As you heard last night from Jeff, the topic for the symposium is reassessing the effectiveness and transmission of monetary policy. So it's a super important topic, particularly right now. And we've got some great papers lined up for this morning. We've got 2 papers, and we also have a panel lined up for that.
The volume should be
before
fine.
we get to any of that, I am delighted to say that we have Federal Reserve Chair Jay Powell here to deliver opening remarks. So with that, let me welcome Jay Powell to the podium.
Thank you, Karen, and thanks to our hosts from the Kansas City Fed. It's great to be back here today. 4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our 2 mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment. In the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss. And this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices,
NASDAQ's up 1.5%.
Savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one. With most mainstream analysts and advanced economy central bankers on board, I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021.
If you can hear that.
Although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns in China. Higher rates of inflation were a global phenomenon, reflecting common experiences: rapid increases in the demand for goods,
Bitcoin at
supply chains,
61,962-ish.
and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade, but labor supply remained constrained. And in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage. And inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023. And we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these
Bitcoin
factors
at
took
62.
much longer than expected, ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced, without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy, and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can
62.3
facilitate disinflation without the need for slack. This narrative attributes
There's
much of
some
the increase
resistance
in
around
inflation to an
62.5.
extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
Okay. That is it. Let's talk about what just happened and what Jerome said, what he didn't say, etc. Let me change something around here. Let me present a different screen. Let me know how you guys are feeling too after that. It seems, I'll be honest, it seems like he was pretty dovish. So that's good. Okay. We'll have to see how this changes. I think it's a little bit delayed, but remember, there's a 28% chance of a 50 basis point cut. I'm not sure he said anything specifically that would make people think they were going to see a bigger cut. He did mention that they have basically raised their rates high enough that they can lower them, pretty substantially. But as you can see, the markets like it. The Nasdaq's up 1.4%. I was saying this while we were watching, but Bitcoin pushed up to 62.3. We are seeing some resistance around that 62.6 mark. By the way, if you do want to trade, there is the link underneath the video to Margex. There's also a link to CoinW, Blowfin, etc. But let's start here. Okay, let me just go over some of the notes that I took, and then we can look at some of the news and some of the reactions and stuff. So Jerome Powell said, "My confidence has grown." One second, let me just get out there. "My confidence has grown that inflation is on a path to 2%. He said that right away. Pretty dovish there. "Today, the labor market has cooled considerably." Again, they have that dual mandate where they have to keep the labor market healthy, but they also have to keep inflation down. "Most of the increase in unemployment has been over the last 6 months," basically saying, okay, we have seen unemployment move up pretty substantially, and it's been very recently, which means that, they have to approach this with some caution, approach keeping rates high with caution. So obviously they're going to cut rates. He said, "It seems unlikely that the labor market will be the cause of inflationary pressures." So yeah, we had the labor market loosening or weakening. We don't really think that's going to be an issue causing more inflation down the road. He He said downside risks to unemployment have increased. So if we keep rates too long, essentially, there are downside risks. And then he dropped the bomb, what everyone had been waiting for, which the market's already assuming or predicting that they're definitely going to cut rates at the next meeting. But he said the time has come for policy to adjust. I believe those were his exact words, saying, we are cutting. We are cutting. Everything has changed. We are pivoting. We are not holding rates steady. We're not raising them. We are adjusting and we're going down, essentially. Then he went through why this even happened in the first place, how we got inflation. I feel like that was the most boring part of the speech. But he said that he thinks that inflation will come back down to 2%. We're on a steady path down to 2%. So in the past, he had talked about like, no, we need to be at 2% before we start considering cuts, right? Or a looser monetary policy. Now he's saying, no, we think inflation is going to come down. We just saw a two handle. We just saw 2.9% on CPI, basically. And yeah, we think it will continue down. So we're going to start cutting now. So overall, I think the markets are pretty pleased with this. Now, are we pumping up to Valhalla? Are we pumping up to new all-time highs for Bitcoin? No. If you look here, Bitcoin's at 61.4, still good, right? We got good news. You have to remember, this is not like this could be a sell the news event, right? It's always a possibility, but this is actually something that's good long-term. Jerome Powell's viewpoints on where they think that inflation is and where they think that rates are going to go is important for the markets. Now, of course, that can change over a period of a couple of weeks if there's some bad reports that come out, but this is important information for the markets to have. And the traditional markets are pricing this in too, with the NASDAQ up over 1%. Like I said, we do face some resistance around this level, which is why I have this position that's very aggressive, 100x, that I timed at the very bottom here against one of these lines. And I took some profit. So I was up 550%. I took about 20% off the table. So I do secure a profit, but I have 80% of my bag still in there. Again, there's that link to Margex if you want it underneath the video. We'll watch to see what changes on the Fed rate monitor tool. This is interesting. Like I said before the video, or before he started speaking, I guess. There is usually some volatility around Jackson Hole speeches. It varies a lot, though, from like 4.4% up one year to 6.3% down the next year. And obviously, it's going to be dependent on a variety of factors, right? It could be something totally uncorrelated with Jackson Hole, or it could be the policy that they talked about. Like in 2021, I believe that was when we were still in very soft very loose monetary policy. Jerome Powell probably around that time said, hey, we're not cutting. And then 2022 said, there are issues in the economy. Remember, that was in the back half of 2022 after we had faced one of the worst first halves of the year ever for the stock market. So yeah, that's definitely going to change how the market views things. You can see $22 million worth of shorts were liquidated in the last hour. Over the last day, about 50 million. So not a ton over the last day, but a lot of that being front loaded in the last hour. That's where probably some of this rally came from. And we are starting to move back up as well. Now, like I said earlier, I was teasing it. Let's do one thing first real quick. Yeah, I have to put someone in timeout here. Sorry, I didn't realize that the chat was going crazy. I will take some questions too. We'll do that in a minute. But as you can see, Russia to launch 2 new crypto exchanges. It's been obvious that they've been getting heavier and heavier into crypto. 1 second. Let me do one thing. Someone's still posting a lot in the chat. Russia to launch 2 crypto exchanges. We know that they've been getting heavier into crypto, looking to create, I think there's even a stable coin that they're looking to create between them and China to do some trading that's going to be backed by one of their currencies. So that's going to be interesting. Russia obviously digging in deeper into the crypto land, into the crypto sector to evade some sanctions. They've talked about Bitcoin being legalized as well. Sony to launch a new public ETH layer 2. I mean, we don't know how much money is going to be put behind this and put into these exchanges. But the fact is, we have nations and multi-billion-dollar companies that have nothing to do with crypto that are now building in crypto. So I think that is interesting. There's going to be more infrastructure build out. There's going to be more possibilities. At the same time, you can't just, invest into crypto blindly right now. Justin Sun is reassuring users after the Tron DAO reserve withdrew 12,000 Bitcoin or $750,000 backing the USDD stablecoin on Wednesday. I'll be honest, I don't pay attention to USDD very much, but this is supposed to be similar to like USD. I think this is an algo stablecoin, and this grew really quickly to 700 million and has just basically stayed flat. No one really uses it. The 24-hour volumes at 5-10 million, probably like just things that they push people to use, or maybe the company itself uses USDD as well. But yeah, I am not touching algo stablecoins anytime soon after the UST collapse. This is a little bit concerning, but keep in mind, no one really uses this. This is a $750 million crypto, and Tron, which is now backing up apparently their own coin, TRX, has been doing really well. But now apparently that is going to back the stable coin. It's near, I don't want to say all-time high, because there was a day or two back in 2018 where it hit significantly higher, almost like 24 cents. But it's at 16 cents. So with the exception of this few day span, it is close to all-time highs, and it's around a $13.7 billion market cap. So it should be able to, unless there's some kind of Luna UST spiral collapse, I'm not too concerned. I'm not invested in either of these either. Robert F. Kennedy Jr. is now withdrawing as a candidate for the president of the United States, and it sounds like that he's basically going to back Trump as well, which I think the markets like, just generally. Again, it's not even a political thing. It is political, but the reason for that is because Donald Trump talks about tax cuts and Kamala talks about tax increases. I'm assuming that is why the markets favor Trump. I think that's pretty obvious. We're gearing up for an exciting Q4. This is typically the best quarter for Bitcoin, whether you look at the average or the median, and we're getting out of the worst quarter for Bitcoin, with Q2 being the second worst quarter. So should be interesting. Should be a fun end of the year. Let me know if you guys have any questions. Let me see. And if you're wondering what Jerome Powell said, you can scroll back in the video. I actually did a little bit of a explainer as well after he got done speaking. Okay, let's see what else is happening. I'm just scrolling to see if there's any other news. Yeah, people are saying Powell went full dove. The cooling in labor market conditions is unmistakable. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. The time has come for policy to adjust. The direction of travel is clear. Yeah, very dovish. Your view on copper? Honestly, haven't really looked into it too much. I don't know what kind of tailwinds we have with copper. I thought Q3 ends on September 30. Yes, it does. I'm just saying we are, we're heading into it. We're over halfway done with Q3. Things should pick up too after the holidays, typically. At least there are more people announcing more things. There are more people working. Right now, there are a lot of people that are at the big financial firms that are just on vacation, right? They're wrapping up their summers with their kids on their yachts and at their beach houses. Will there be any major capitulation event? There's always going to be a capitulation event. There's always going to be some crash, some worry. But right now, I don't see anything directly on the horizon, to be honest. Of course, there could be something, right? Maybe some economic data comes out and then everyone freaks out. Maybe some other entity in crypto decides to drop 40,000 Bitcoin. Keep in mind, that's what happened July 4. I don't remember what happened August 4, but back in July, it was Germany just selling a bunch of Bitcoin. If you could go back in time and had one piece of financial advice for your 18-year-old self, what would it be? Ooh, I'm trying to think. Honestly, it would be to buy Bitcoin. That would be the most obvious, but that seems like a cop-out. Even even talking about buying real estate, I wasn't in a position to buy real estate then. If we were going with something that's just like anyone could have advised me to say it or to do it without knowing the future, probably it would have. I loved college, but it wasn't a good financial decision. I'm not doing anything with my college degree. And I spent a lot of money there. I didn't work for 4 years. I think that's one thing that a lot of people get wrong. Like, if you don't have a clear path, don't spend your time. Like, figure out what you actually want to do and what you don't want to do beforehand. Major capitulation event incoming or should buy now? I actually have a video on my channel. If you just go to my channel, it says, is now a good time to buy Bitcoin or should I wait? And I think it's the pinned video. That should be a good one to kind of explain my thoughts on it. Is the change good or bad? I think it's a good change. I mean, the fact is they're cutting. Like, they made it very clear the Fed is going to cut, which makes it a lot more attractive for people to buy risk on assets. Thoughts on Sundog? Have not seen. Don't know. Don't know what Sundog is. Jack Daniels, appreciate you. Appreciate you for watching and everyone for watching. And appreciate the whiskey too. I do like Jack Daniels. China unbans crypto. Possible? Yeah, definitely. I mean, they're so wishy-washy. What's your thoughts on 128 countries joining the new BRICS and its effect on the dollar or crypto? Yeah, so I mean, just in general, I think it's always better for the US dollar to have more people that just blindly use the US dollar. But it's been very clear that there are people that don't want to use the US dollar, don't want to be denominated, don't want their currencies to be denominated in the US dollar. And I think some people realize that Bitcoin could be the next currency, which is why there are some people trying to get a hold of a lot of Bitcoin. I thought it was 4-year cycles. Wouldn't that make Q4 2025 the target for all-time high? Yes. Some people, though, think that just because everyone is thinking that's the peak, that it will happen before. That's always the question. It's like a game of musical chairs, right? If everyone thinks it's Q4 2025, well, then the smart money is probably going to sell in Q3 2025, which means Q3 will be the peak. At least that's how some people think. Other people think, no, it's just going to happen just like it always has. Eat with Turner. Appreciate you giving the super chat. What are your thoughts on Stacks STX? Let me pull up Stacks. I haven't looked at it in a long time. Just pulling it up here. I believe, if I remember right, this is the Bitcoin layer for smart contracts. Honestly, I think things that are built on Bitcoin will get more popular over time. I haven't looked at Stacks specifically in a while, to be honest. Like, since March, when it kind of pumped to all-time highs. I remember it was one of the best performing cryptos. But yeah, I think things that just in general are built on Bitcoin will get more attention. Bitcoin has been outperforming, and anything that can increase usability on Bitcoin it's probably good. Now, obviously, you have to look at like the supply schedule and stuff like that. Yeah, it looks like it's fully diluted, which is good. Or like, oh no, the circulating supply is 82%, which honestly is still good. Market cap 3.2. Yeah, I think this could do well during the bull run. But yeah, without diving in much deeper, that's kind of my thought on it. The ETFs causing the pump in March kind of messed me up a bit with some of my buys. Yeah, I mean, I think it messed up a lot of people, especially because it was right before the halving. So people were thinking, okay, the halving is a massively bullish event. We're pushing up so far or so fast in front of it. We'll probably continue to move up to 80,000, 100,000, something like that. And then, yeah, it just was a bit of, I think it just happened too quickly. And then the ETF stopped buying for a little bit, right? Like, we saw massive inflows and it kept on exponentially going up and then trailed down and actually went negative for a little bit, which we hadn't seen before. And then we had some massive overhangs too. Nathan says back to 62. Yeah, let's see where Bitcoin is right now. 61.8. Yeah, not bad. Not bad. What's my age now? Upper 20s. I'll just say that. Is it the right time to buy? Again, I have a video on my channel that just says, like, is now the time to buy Bitcoin or should you wait? I think it's the pinned video when you go. How low do you think Bitcoin will go during the next bear market? Very difficult to know for sure. But based on what we've seen before, it went 20% lower than the previous all-time high this last bear market. So like 2017, we went up to what, 19,000? And then in the 2020 bear market, or the end of the 2020 cycles bear market, so 2023, we saw it go down to 15.5. So if we're thinking 20% lower or something, that would put it, the 2021 peak was around 67,000, something like that. So 20% lower than that, maybe low 50s. That was kind of my thinking this last like year. But after seeing Bitcoin fall down to this level, which is a key level, 49,000, we had seen this before. Yeah, you can see resistance here, support here. I would not be surprised if this held up. I know that sounds crazy, like a $48,000, $49,000 Bitcoin in a bear market is awesome because that's like 20% lower. Like you'd have to really screw up if you bought now to have to sell at this level. But yeah, that's kind of my thinking now. Of course, it depends on how viciously we move up, who's buying a lot. But with the ETFs, I do think there's going to be, I think that hedge funds will sell at some point, but there are also going to be entities that continue just to swallow more and more Bitcoin too. Brian says never selling. Hey, fair enough. Everyone's got their own plan. John Hay says college is a good time for drinking. You'll never have so much drinking time again. True. Yeah. Getting off like full days during the week just to go bar hop. Thoughts on Solana versus Ether bull run performance wise? I mean, Solana's already outperformed so much, but a lot of people would think that Ethereum will probably have its day, but I do think Solana is still going to do quite well, and it's still small compared to Ethereum overall. So I'd say Solana, if I had to like gun to my head, probably Solana will outperform a little bit. Okay, I should probably wrap this up. I'll go like rapid fire. Someone pour me a double shot of whiskey. Yeah, with a little bit early for that here, but later today, maybe. Lots of love from Australia. I listen to you most mornings on the way to work. Appreciate that, Rusco, or Rusco. I love Australia. We went there, my wife and I went there to the Gold Coast, and it felt like paradise. We were up in a Airbnb that was like on one side was a cape, on one side was the ocean, and there was no like driving there except for like coming up to the Airbnb and parking. We were on this little cape, and it wasn't that expensive either. Like I've been in like kind of crappy Airbnbs before that were more expensive than that. I think it was, around 200 or maybe 250 a night. And it was beautiful. Like that would be $1,000 a night in other places. Shout out from Minnesota. Appreciate that. Thoughts on when Bitcoin hits 120? When it does, what will be the bottom? Yeah. So we talked about the bottom there for a second. We actually have some friends from Minnesota too. I think Bitcoin hits around 120 this bull run. I'm not sure if that's super helpful because a lot of people think that, but yeah, I think it will be towards the peak this bull run because you have to remember too, at the peak, things move very quickly. So even if you think Bitcoin's going to hit like 180, 200, 120 is probably going to happen relatively close, like a month or two away from that, or at least it could, right? Things get kind of exponential towards the peak. Phantom now lets you buy crypto from MoonPay directly from the wallet. That's cool. Okay. I think we're just going to scroll through, see if there's any real quick questions. All right. I appreciate you all being here. Sorry, we had to stop some of the questions towards the end there just because, yeah, I have to get off here in a second, but appreciate you all being here. Hope you're doing well. Again, overall, the speech seemed pretty good. Let me know your thoughts underneath the video or in the comment section or in the live chat as well. You can scroll back if you didn't see that. If you don't mind, on the way out, just hit like, subscribe. There's that link to Margex too if you want to trade cryptocurrency. It should be a fun next year plus maybe. Thank you so much. I'll see you all in the next one. Bye.